You've been warned. And he's going to talk risk management. And just generally, I mean, URS, these guys manage 45 billion,
About, yeah.
about $45 billion. And they've got all types of different asset classes. So he has exposure to a bunch of different things, but he's specifically thinking about the risk side of it. So risk management, risk analyst. And so, listen, any questions are fair game. I realize you guys have no background. You have never maybe even heard of a risk analyst or risk manager before. So no question is off the table. If I feel like you're not asking good questions, I'll ask you to ask a better question. Not a better question, just a question. So be involved. Let's hear from Guy, and we'll go from there. See how this goes.
Can I tell them 2 stories about you? The first,
Sure.
the first is we were at some neighborhood event, and Ryan was over against the wall, and there was a couple other gentlemen, and they all had shaved heads for some reason. And I remember your oldest, Jonathan, he was 2 years old at the time. He said, "Mom, which one's my dad?" He couldn't tell which one you were because the shaved head dominated.
Listen, you're not. You're catching up to me.
I'm catching up to you.
So,
That's those of us with beautiful heads that want to show them off. I'm joining the club slowly. The other one was have you guys heard of the game Settlers of Catan? It really came on strong in the mid 2000s. And we played a couple of times, and I was so not used to losing. I was like, oh yeah, I love this game. I win every time. And Ryan beat me. So that was like mind blowing for me. So if you think after I talk that I'm reasonably intelligent, just know that your professor is even more so. So Guy Foutz, is the mic on?
Yeah.
Okay, that's a nice speaker system because I don't hear the echo. I am the investment risk officer at Utah Retirement Systems. As was mentioned, we're right now about just shy of 44 billion. We manage the retirement benefits for anybody that's employed by government. So who has a relative that's a teacher, firefighter, policeman, state, county, city worker. I tell people when I find that out, I work for you. I work for them. A typical teacher, if they work 40 years, say their final salary is $100,000. Their pension for the rest of their life will be $80,000. And we're the pool of money that sends that money out to them. So I believe strongly in what we do. I have my whole career been one of my passions is financial security. So I very much appreciate being able to work at Utah Retirement Systems and do that with the state program.
Is that the typical pension payout at retirement? So the full retirement is 80%?
If someone was hired a while ago, it would be 80%. They've updated it where it would be muted a little bit. It would be 66% or maybe 60, I'm not sure, but they get a richer 401k. So yeah, so we manage the defined benefit separately. We touch the 401k, but we're not as hands-on with that. There's the employee takes on the risk in a 401k. For a defined benefit, state of Utah is taking it on, and so I'm a risk manager as a result. We have one. A little bit of my background. I was born and raised in Las Vegas, Nevada. I didn't learn anything about card counting then. I learned it in my statistics class. I was good enough at math. I was like, someone sent me a letter saying, hey, you got to be a stats major. I was like, sure, sounds great. I learned what, anybody heard of an actuary here? Just a little higher, sorry, 3, 4. Okay, so there's a handful of you. I learned about actuaries, and someone said, yeah, they'll pay you to take exams. So I said, okay, good enough. I became a life insurance actuary. I got my fellowship there. These are hard math exams. I never had problems with math, but to pass an exam, you need 60%, and I'd be thrilled if I got a 62%. So if you ever meet an actuary and they don't have much of a personality, that's because these exams have sucked the personality out of them. And you might gather that from my presentation here as you interact with me. Became an actuary, enjoyed it. I got more and more into asset liability management. Anybody here been exposed to asset liability management? Insurance company, they sell insurance product, they take in premiums. What do they do with the premiums? They invest them, okay? That way, when they have to pay out in the insurance in the future, they just sell the assets and you can pay it out. But you want to make sure they're matched well, okay? You don't want to invest in venture capital for a life insurance product. Usually it's bonds. So that was my work there. It was very rewarding, very interesting, but I was getting more and more involved in the investment side of things. So I decided to pursue the CFA designation. Anybody here pass CFA level 1? They make you wait forever. Yeah. Yeah, let's commiserate. Let's commiserate afterwards. It's terrible. I pursued the CFA exam, and right about that time, I was finishing up. This thing called the Great Financial Crisis happened, and the insurance company I worked for had a lot of mortgage-backed securities. But don't worry, they were all AAA rated, right? Some of you guys have seen the movies, The Big Short, or what are they? What are the movies that talk about it? Steve Carell, The Big Short, okay. And so my boss, the chief financial officer, he said, hey, you are not in the investment department. You're separate, you're independent, you're getting your CFA. I want you to value all these mortgage-backed securities. Well, if you remember from the movie, it's not as easy to just say, oh yeah, this is worth that. I led an effort to try to find out the economic value, the intrinsic value. It took a lot of modeling, a lot of consultants to arrive at an answer at what they were really worth. And that's where I just kind of got thrown into the deep end of investment risk management, and I've been working in it since. Right after that, I went to Utah Retirement Systems. Like I said, I'm the investment risk officer. I'll touch on my role there, the structure there in a minute. What I do, there's no book for what I do. There's no textbook for how to be the risk manager for, in the industry, they'll say asset owner, asset allocator. But for pensions, foundations, endowments, anybody know, I assume Utah State has an endowment. Do you know how big it is? Okay. So for example, Yale's endowment is about 45 billion. That funds about a third of the university's operations every year. Not too shabby, right? You guys wouldn't mind it if your tuition was 33% less, probably. The U of U, for example, I just know their stats. Their endowment is about $1 billion, and they pay for about 1/50th of their operations. So that's just barely scratching the surface. I don't know Utah State, but when you guys all go out there and make a lot of money, you can donate to the Utah State endowment and then catch up to Yale. Fair enough? I see nodding. I'll take that as an agreement. This is being recorded. So anyways,
One other thing.
Yeah.
Terms you don't know, like when he talks about, like, we haven't talked about mortgage-backed securities. Some of you don't have tons of background in finance. So don't hesitate. We kind of understand what he's talking about. And then we don't need to stop him with all of those. But if there is something you're just really not sure about, ask. And if it's something else that you're maybe kind of understand but not super clear, just write that down as well. We can go over some of those things. So don't hesitate to keep notes of stuff that isn't clear or to chime up if you're not sure about
Yeah.
the different securities.
yeah, please do.
Whatever else.
Is the endowment everything except for tuition? Or is it specific?
I'm not sure I understand your question, but endowment, people will donate to the school and say, here's a pool of money to help.
Governments or
Say again, sorry.
does it include governments at all?
I don't, the government is not going to give you more money than you need. So I don't think it's money from the
It's just
government.
for people-
Yeah.
okay.
I mean, who built this wing? Huntsman? Yeah, that would be an example, but maybe he donates.
Yeah. A
Yeah,
whole bunch of people did. So they'll pull money together for a university or for a specific cause, like there's professors that are endowed professors, they have an endowment that pays off a little bit of money each year to support their salary or their, you know, a specific project or a specific thing. So universities have large pools of money to pay for operating and other expenses, and they have small pools of money to pay for very specific items as well.
Yeah. These last two, I belong, a group of us risk managers started an organization about 12 years ago, Institutional Society of Risk Professionals, where we meet and we talk about what we do since nobody else does it. And then, yeah, we have a really cool club. I'm actually flying to Ann Arbor tomorrow for that meeting. And then I was talking to someone at the University of Utah 5 years ago about this, how there's no textbook on what we do. And he said, well, why don't you teach a class? So for 3 years, I was an adjunct at University of Utah teaching risk management for multi-asset class investing. Very rewarding. If you have any adjunct professors, bring them a donut or something like that, because they don't get paid enough for their work. Okay. It's a labor of love.
Yeah, basically.
Yeah.
Very, very.
So that gives you a feel for the fellow with the monotonous voice that's standing in front of you. Any questions on my background?
How long is each one of these?
I was basically a actuary for 14 years, and I'm coming up on 13 years at Utah Retirement Systems, so almost 50-50. Yeah. If you want to stick around afterwards, I can share actuarial jokes with you. They're just hilarious if you have the right audience. Some of the things we'll talk about, I'll give you an intro, how we think about risk at Utah Retirement Systems, some of the risk metrics. Real quick, who's not a finance major here? Just yell out what your major is if you're not finance. Math major? Business management? Was there another hand or two? Econ? Okay, everybody else is finance.
Or not sure. I mean,
Or getting there. Okay, thanks.
I don't think you don't have to declare at this point. How many are undeclared?
Here we go. Okay. Who's had a statistics class, 101 or 121 or whatever it might be? Can you hold them up higher? Okay, so we're maybe 40%. So I'll explain some of these statistical
The other ones will
measures.
have it by the end of the time they finish.
Yeah.
At some point.
And you can say, oh yeah, that's what that one guy was talking about. That was talking in the class. Okay, so we have, sorry, I'm gonna move off of that so I don't distract you. We have 44 billion. We invest in public equity, private equity. We invest in real estate, some energy and mining, timber, agriculture, bonds, and we do hedge funds also. So not every flavor of investments, but we do touch a lot of them. We want to have a diversified portfolio. We are cognizant. Has anybody heard the term diversification? Where it's kind of like you're so diversified, you're just kind of getting the market. We are cognizant. We don't want to just get market exposure. We want to get some, what they call alpha, anything above the benchmark. We want to get extra return. And I touch all of these asset classes in my role as risk manager. We have what we call a downside protection model.
Yeah, you got a question.
Oh, thank you.
I'm gonna ask, what's your biggest share, or is it so diversified?
Biggest share, like in a company?
Of what, loans, what do you do the most?
Equities. Equities, our allocation, our target is 37%, but it's down to 32. That's not because of, it's basically because our private equity and our real estate has done so well, but we can't sell those fast enough. We don't want to sell them fast because we don't want to lose value. And so equity is kind of the cushion. Public equity is the biggest one, followed by fixed income at about 20%. And then real assets, real estate, ag timber, that's 15%. Hedge funds are 16%. Okay, so we have what we call a downside protection model. We want to have reduced volatility, and this is something I want to show later how we did during the COVID-19 drawdown. One thing we do is we're continually monitoring and managing the risk, and especially the liquidity. I'll talk about that again. And then in my role, and I think any risk manager's role, they want to continually look at the environment. You don't want to just rely on your numbers. You want to say, what's the landscape out there? Is there a reasonable roadmap out there?
If you just define liquidity.
Oh yeah, thank you.
And then say, like, an example of your most liquid asset and your least liquid asset, or
Yeah.
something in
Yeah.
each bucket.
Most liquid asset we have would be public equity, Alphabet, Google, all the FANG stocks, Facebook, Amazon. Is Netflix really one of them nowadays? Google. You can sell them easily. Okay. Large cap stocks are very liquid.
Even large amounts, so
Yeah.
millions of dollars worth of one of those stocks you can sell.
Yeah, I think, I don't remember the amount, but we have 400 million in some of those names, and we could sell them pretty quickly if we had to. Least liquid would be timber growing in New Zealand. Okay. We can't just sell that tomorrow. If we really wanted to sell it, it would probably be a 2-year process to get what we want out of it. Now, don't get me wrong, we could sell it tomorrow, but we'd probably take a 40% haircut and not get what we want out of it. But to get what we want out of it would be a long process. Real estate is illiquid. Bonds are liquid, usually a little less liquid than equities. You had a question?
Yeah, why New Zealand?
Sorry?
Why New Zealand?
I don't know. We bought it there before and it was a good opportunity. We have partners and they'll usually bring deals to us. It was probably a situation I described where someone really had to sell. And we said, well, we're a ready source of capital and we tend to be good partners. So we'll buy. I'll talk about our setup. The only reason I have this slide is to say that I report directly to the chief investment officer. If your risk manager should be able to have a voice. In some organizations, they don't even report to the chief investment officer, they report to the board. And just to give you another feel, here's our public markets, equities, fixed income, private equity, real estate. We have an operations group. I won't spend much time on that. So here's a
There's other folks from URS coming.
22nd.
Class.
Oh, go ahead. You,
22nd.
are you talking about when we do the lunch meet and greet thing?
Yeah, there's another group. So from, I think is just Jason, or is it also?
It'll be public markets, private equity, and real estate.
Yeah.
So it'll be
So those first 3 columns, someone from those first 3 columns is coming to talk to Aggies and.
yeah, Jason's alumni here, Scott's alumni, and I think Ted
Yep.
in the real estate is on the 22nd. And I don't know how they get that word, but through the
Yeah.
department.
Yeah, so this is why if you
Okay.
need to be part of the clubs, right, if you're part of the finance club, we'll send out another announcement, kind of advertising for that or letting people know. So anyway, we're gonna see other folks from URS in the near future.
And it looks like I'll be back that day if you're totally enamored with what I have to say and want to go deeper. Okay. Usually if you have 10 people in a room and you ask their definition of risk, you're going to get 10 different answers. So just throw it out there. I don't know if you do participation points, Ryan, but what's a definition of risk? Blue shirt, you look like you're about to say something. Yeah.
Yeah, so I think it's like making a choice that could have potentially negative consequences.
Okay. Okay. Other thoughts?
Like how volatile something is?
Okay, yeah. Particularly in an academic sense, volatility is a very handy substitute for risk. One more.
It's a situation in where something you value is in danger.
Did you just Google that?
No.
Okay, that's pretty good. Yeah. Usually, there's, and I was just kidding. Didn't mean to sound like I'm accusing you. Terms thrown around are uncertainty, volatility, probability of loss. Think of it rolling a dice. Is there uncertainty there? Yeah. Is there risk there? If I pay you $1 for every number that's rolled on a dice, is there risk for you? No. If you pay me $1 for every number that's rolled on a dice, is there risk for you? Okay, very different scenario, but the probabilities are all the same. So that's my issue with uncertainty. It depends on what's at risk, what the payout could be. I'll take that any day where someone will give me $1, but then the market will bid it up and you'll arrive at a price where it's perceived to be fair. Uncertainty, volatility, probability of loss, that's what we land on when we invest. It's risk versus opportunity. You touched on this a little bit when I accused you of looking on Google. It's the probability of loss versus opportunity. For every opportunity, there's usually a downside. And so we think in terms of informed risks, okay? There's a little thing about risk and opportunity are different sides of the same coin. And then again, the URS approach, lower vol, lower drawdowns. We hope to do quicker recovery when there are drawdowns. Drawdown is when you lose value, okay? If you have $100 and you lose money, if it goes down to 90 and back up to 95, you're still in drawdown, okay? It's not until you get back up to $100 that you are out of drawdown. That's just a term in the industry. Other questions? I'll keep going. My role is I work with the chief investment officer on overall risk asset allocation. If you think it'd be cool to do asset allocation, risk reward, you may want to look into risk management. And then analysts, the group that's going to come on the 22nd, a lot of these guys will do the bottoms up risk analysis. You do the top down asset allocation, bottoms up, and you get the portfolio construction in between.
How do you think of those? They're coming first, you're coming second?
This is asset allocation. They will bring deals. So once we know what we want to invest in, so that's kind of first, that's the backdrop. And then they say, well, here's some managers. Every manager that goes into the portfolio, when I say manager, I'm talking about an external manager. For example, big names out there, Ray Dalio, anybody know that name? Bridgewater. They manage money on behalf of pensions, foundations, endowments. So that would be an external manager. That's why I'm using that phrase. Any new investment that comes into the portfolio, I will opine on it. I'll look at it. I'll run a risk reward analysis on it to say, what does it do for our overall portfolio?
So you're thinking of it globally. In connection with everything else, and these folks are just thinking of it individually. So
Yeah.
one guy's looking at a property, looking at his investment, should we buy this property, this big building in New York, or should we not buy it? They look at it individually compared to other real estate. Guy's job is now let's look at it abroad, across, we own lots of buildings in lots of different cities. We own timber, we own all these other things. How do these things relate? How do they connect?
Yeah, an example in the past, this hasn't been an issue because if the portfolio keeps growing and kicking off money, you can just invest. There's no competition for capital. When I use that term, it means you only have $100. You have to decide if you're going to invest in a building or a hedge fund. But now the way the market's behaving is kind of like, okay, well, do I want to invest in a building that's kind of not exactly a sure bet, but a little more certain what the cash flows will be, but is very much correlated to the economic cycle versus a hedge fund that has a lot of uncertainty about how those cash flows could play out, but very uncorrelated to the economic cycle. When I say economic cycle, am I just putting you guys to sleep? You with me? Okay. One thing that we look at is how do different asset classes behave in different environments. So primary in the industry is you think about inflation. Is it a low inflation environment or high? And then growth. Is it a low growth environment or high? And these are some of the assets that do good in these different quadrants. Low inflation, low growth, really good for high grade bonds, really good for cash. Low inflation, high growth, which has kind of been our environment for the last 12 years pre-COVID. All of these do really good. So you kind of get, you've had a huge tailwind for the last 12 years or so. High inflation, high growth, a little more challenging, but commodities, real estate, energy, those tend to do good in that environment. You asked about our our biggest allocations, public equity. The reason why it shrunk, like I said, is because our real estate in this inflationary environment has done really good. That'll probably come down a little bit in the coming quarter when they revalue them. And then you got some that straddle. Agriculture tends to do good in high inflation. People like to eat; they'll pay for food, whether it's low growth or high growth. And then you got our hedge fund portfolio tries to straddle all of this, and then inflation-linked bonds. If it's higher growth, higher inflation, we get some protection from that. Any questions on the assets there? I'll walk through some of this. I look at 4 different aspects in general: volatility, leverage, concentration, liquidity. Boom. I just threw a bunch of terms at you. Volatility or risk metrics. What's the standard deviation? Leverage is how much in debt are they? I was alive during the .com bubble, and people would go borrow money on their margin account to invest in stocks, which was great until the stocks crashed, and then they'd owe money to their broker or whatever. How concentrated is something, and then how liquid is it? Any one of these on their own is not going to do you in usually, but a combination of something that's highly levered, highly concentrated, and then you've got a lot of uncertainty in the market, that can do you in, especially if it's illiquid. And a lot of people will say that during the financial crisis, you kind of had a perfect storm with a lot of these turning on people at the same time. Yeah.
What do you mean by concentration?
Oh, good question. If you want to be responsible with the money that's been entrusted to you, are you going to invest it all in Apple? Or are you going to invest in S&P 500? S&P 500 is not concentrated, it's more diversified. Someone else would argue and say, well, that's still all stocks. You should diversify across different asset classes. Why don't you do, like I talked about earlier, 30% stocks, 20% fixed income. That is a diversified, non-concentrated portfolio. Does that help? We will look at things quantitatively and qualitatively. Quantitative is very handy. Numbers are helpful, right? They give you an indication. But you should not be married to your numbers, okay? Don't be married to your model. There seems like there should be a joke in there somewhere. But we want to look at qualitative aspects of risk. Anybody who just wants a number, I heard a risk consultant say this once, and I liked it. Anybody who just wants a number is being lazy. They don't want to engage in the story that contributes to that number and what could go right or wrong. I like this one. All financial models are wrong. Some are useful. Is that like acid on your ears, Ryan, since you teach? And okay.
I think it's easy to get carried away. The way I phrase it sometimes is, are you precisely wrong? You can go out 10 digits, you can calculate some number in finance out 10 digits and say, oh, look, I just calculated beta in 10 digits.
Yeah.
And it's completely wrong, and it doesn't have any relevance to what you're doing. And so I'd rather be somewhat right than completely wrong.
Yeah. I've heard it put, don't confuse precision for accuracy. And the word I end up using is it indicative? Is this number representative? Is it in the right direction? Again, I talked about risk is not a number. And often a good quantitative analysis helps you know what questions to ask down the road. Some of the stuff we do, I'll get into the risk metrics, just kind of give you a feel. The way my boss put it when I started is he said, I want to triangulate risk. I want multiple perspectives. I want a mosaic. It's not just one metric or another that's going to give me the answer. Oh, okay. I'll touch on this a little bit. How do you do risk in a multi-asset class portfolio? How do you calculate risk of the S&P 500? Okay. But what do you do with the data? You said beta, but I'm talking about you get daily data. What do you do with that? You add it up. In a spreadsheet, you type in standard dev. You decide if it's a population or a sample, and you get a number. How do you do that for a office building in Manhattan? Well,
Really good at
You really get, yes, thank you. Did you Google that also? Stocks, what's that? Okay, stocks are marked daily. You know what it's worth to someone. A building is valued annually and maybe with a quarterly refreshment. So it's hard to bring together the stock aspect, the private equity, the private real estate, and say, here's the risk of an overall portfolio. I won't go on this too deep, but we use a system from State Street as a big custodian bank. I think they manage about 50, not manage, they custody about 50 trillion in assets. Who knows what the US GDP is? It's about, I want to say 40 trillion annually. So one custodial bank custodies, meaning they make sure it's secure. Think of an old-fashioned bank where you have money in the safe. They custody more than the annual GDP of the United States. And then you grab the other big custodial banks, Northern Trust, BNY Mellon, huge amounts of money. Anyways, I digress. They have a risk system called TrueView, and it allows us to aggregate risk across these. Now, I asked the question, how do you do risk for a real estate or private equity? We use what's called a risk proxy. I won't go deep on that, but something that is indicative of the intrinsic or the economic risk of these asset classes. Okay, I don't want to say intrinsic too much, or I'm going to lose you guys. And then we take today's holdings, instead of just looking at historical stuff, we say, here's today's holdings, and we're going to subject them to shocks and all these things to get a distribution of outcomes. Once you get a distribution or a feel for the uncertainty, how things can go, you can start doing metrics on here. You can start saying, well, here's the probability of it being higher than our target, and here's the probability of it being lower. And man, this guy over here, I do not like that. I don't want to incur a loss like that. You can do these risk metrics. Fair enough? Any questions on that? So here are some of the risk metrics we look at. I'll just jump in. So for our overall portfolio at the time of this that I copied and pasted this, we said our volatility, our annualized standard deviation was 10.4%. If you haven't had your stats class yet, I mean, standard deviation means on average, this is how much you're going to vary from your target. So if we're targeting 7%, it's 6.85. Yeah. Our actuarial target is what they'd call it. If we're targeting 7%, 1 year on average, you'll get 17%, because on average, you're going to be off by 10%. Another year, you'll be minus 3%, because 7 minus that standard deviation of 10 is minus 3. So you can see that even though 7 is our target, we're not going to hit it every year, but there's going to be a lot of volatility, a lot of bouncing around there. Now, if you had entrusted all your wealth to someone and they told you, yeah, 1 year you'll get 17, 1 year you'll get minus 3. If you didn't know about statistics, the markets, that might make you nervous. But if you got informed about how things work, then you might say, okay, I can tolerate this. This is an intrinsic standard deviation, meaning we represent things by what we think their true economic exposure is versus accounting. Accounting, private equity, real estate, volatility is really low on an accounting basis. And that's all I'm going to say about that. We have our value at risk measure. That's a tail measure that says 5% of the time you're gonna lose 5.53% or worse. And then someone mentioned beta. What's the definition of beta or market beta or equity beta?
Yeah, so it's just all the risk that's diversified away. So it's the risk of the market. They're getting rid of all the idiosyncratic risk, like what if the CEO resigns of a certain company because it's all diversified.
Okay. So market exposure, if you have a beta of 1, that means you're basically getting market exposure. If the market goes up 1%, you'll probably go up 1%. And more specifically, it's about the volatility in the market. Like I mentioned, we want to have a low volatility portfolio. So our beta, our market beta to the FTSE Global, which is a benchmark, is about 2/3. So we participate in about 2/3 of the volatility because of that, we won't get as much of this upside that some groups will, but we'll also protect on the downside over here. A lot of endowments, they'll have a beta of about 0.75, sometimes 0.8. Same with public pension funds. We want to see how correlated we are, and I could geek out on skew, but that's just how much the left side tugs versus the right side. You want things skewed positive. You want more positive exposure up here. I don't want to go deep on the other asset classes, but you can kind of see how each of these, if you just look at volatility, some are more vol, private equity, equities, some are less, they're diversifying, how they all kind of come together for this 10.4%.
So are these your actual business calculations, or are these what we can allow for?
Oh, good question. I appreciate you bringing that up. These are our actual, I would call them simulated calculations. And then separately, we won't really get into that. I'll touch on it. They have risk budgeting. Is that what you're getting at? Cool. Let's talk afterwards. So a risk budget is how much you want to, how much volatility you'll tolerate.
When you say simulated,
Yeah.
some of these have actual numbers. You can find the volatility of public equity.
Yeah.
And the simulated part comes because you don't have graded numbers on some of these other ones, or is it simulated because you're kind of just going through scenarios?
It's probably a public stock, you can go get the historical volatility. All right. It's just market is the only real factor. Unless it's an international stock, then you'll have currency, market and currency. Probably the best way to think about this is, what is the 20-year volatility number for a 10-year bond? Wait, what? It's only a 10-year bond, so how can I have volatility for 20 years? You can't. The way you do it is you would take a bond that you own today, and you would shock different factors of an interest rate, credit spread, for example, currency if you had it. You would take today's bond and subject it to the shocks over a 20-year history, since I use that 20-year example, to see how the price would move around under those different shocks. And that's the simulation. So it's kind of a marriage of, these are today's positions subjected to historical shocks. Okay, I'm sure I'm losing you guys. I have more color here a little bit. I have a little canary bird I'm going to show you. Any questions on this? Okay. And we look at history also. Okay, speaking of color. So I use the example here of volatility being 10.4%. Well, what makes up that volatility? Here's where we look at the different asset classes and say, okay, absolute return hedge funds, based on your weight and your volatility, here's what we would expect you to contribute to volatility, 8.3%. Equities would be 58%, fixed income 4%, private equity 20%. But then you get this thing called diversification benefit, where it brings it back down to, and this would be the sum of that 10.4% standard deviation. This is my job, is to try to expand that yellow space to get as much diversification as I can. At the time I created this slide, a lot of things were correlated, because 8% doesn't seem like that much. We've seen it as high as 20, 22%. But in the current environment, things seem to be more correlated. I was going to move on unless there's a question there. One thing that this emphasizes is that contribution to dollars is not the same as contribution to risk. So for example, though equities and private equities make up about 51% of the assets under management, the 37 plus the 13 is about 51%. They make up 78% of the volatility. The 57 plus the 20 is about 78% of the volatility. Stocks usually dominate in risk in a multi-asset class portfolio. So that's some of the metrics we do. You can see here hedge funds diversify because their contribution to risk is lower than their dollar contribution. Same with fixed income. It historically, or at least the last 20 years, has been a diversifier. And then we look at risk factors. Rather than focus on that one, I'm going to move on to this one that says our overall portfolio. You can see the equity risk in there. And you can see some of the other, sorry, that's so small, high yield risk, idiosyncratic is what you want, but different asset classes, fixed income is very diversified by the different factors. It's rates, it's inflation, there's some currency and idiosyncratic. But again, equity risk tends to dominate even in non-equity asset classes like real estate. And then allow me to geek out. This is something we're doing. We have a hedge fund manager that is saying, hey, we're so great. And so what we did is we applied what's called the feng shui 7-factor analysis to see where they're making their money. If you get into multivariate regression, this is a tool you can do. And maybe after I explain it, you'll say, okay, I can see why they pay geeks a lot of money to do that. This manager is making their money off of some primitive trend following stuff. I won't elaborate on that, but the green is equity risk. The lighter green is emerging market risk. They're going long and short bonds with credit spreads is the yellow, and the kind of salmon color are interest rates. So we can decompose this and we can say, look, down here again, don't let these numbers, the fit of the model, the reliability of the model called R squared is about 60%. So we can explain about 60% of what this manager is doing. And these are the dots are how much above the benchmark or what you would expect them to make. If it's above 0, it's positive. Okay. They've been doing great, but the last couple of years, they keep dipping. So we can have a conversation with this manager to say, look, explain to us, we understand what you're doing up here, but what has happened since you've gone into this asset class that has eroded your excess returns? So that's just something that we do to, it's interesting to see the look on these managers' face when they say, oh, wow, you did figure out my portfolio. But often they have a story that they can tell you. Sometimes they don't. And that's when you don't usually invest with them. I don't expect technical questions on this, but the application is we can pick apart returns of a manager and kind of challenge them to say, would we be getting our money's worth if we're investing in you? Because your grandma can't do this with her retirement, not usually. And people are sold investment products every day without tools like this to be able to say, is it worth my money or not?
So what program are you using for this? Are you using like R?
This is R. This is one of their libraries. My analyst had to do a lot of tweaking. This is rolling 36-month regression. So each dot here, it's doing its own regression analysis, stepwise regression to decide what's significant, what it's going to kick out. Okay, we'll do stress testing. Part of my job is to be able to say to the board of trustees, say, hey, look, if the S&P drops 20%, we're going to drop about 13%. I want them to know that beforehand. Okay, in investment management and in investment risk management, you do not want the decision makers to be surprised. You want to tell them beforehand what's going to happen. There's some other ones. If Lehman collapse were to happen again, .com bubble, etc. We okay, Brian? Or yeah, okay. So that was all volatility. Now we're talking about leverage. How levered is the portfolio? So if I go out and buy, yeah, we'll go with Amazon. Buy Amazon stock. Have I bought any debt? You might be saying, why are you asking me this? I just bought a stock. Does Amazon issue bonds? They do, not as much as other companies. But in buying an equity, you have bought leverage, exposure to the market, because an equity, most stocks, whenever this was calculated, the S&P 500 on average was about 232% levered. okay? So even though you buy a stock, there's implicit debt in that, and I'm sure you could elaborate on that more than I could. But we track leverage over time. Private equity manager, general partner, they will go borrow from the capital markets in order to buy companies and build them up, do their mergers and acquisitions. Real estate, usually if any of you own a house, you probably have a mortgage. If you don't have a mortgage, good on you. But people borrow to buy these things. So why do we want to track leverage over time? Notice this is not a complete picture, because some we have good data on, some we don't. Our hedge fund managers, they will use leverage. That swings around. What we want to do here is track trends over time. The canary in the coal mine, I think a lot of you guys know this analogy, but they would take birds down into the mine, and if there were poisonous gases, the canary would die first. That way the miners knew that they needed to get out. This is just indicative of what the market is doing. And 2008, things were reaching all times high. The leverage in the equity markets has not gotten anywhere close to where it was during the 2008 financial crisis. So that's something we'll monitor. Oh, you're doing this half question thing.
Is there obviously you don't want this high leverage, right? Is there a limit?
Yeah, there's a limit.
Is
I
there,
mean,
like, laws in place for,
I'm not familiar with all the banking laws. There are things in place, and also that's opened up capital markets to others that has given them opportunities, because banks don't loan so much anymore to oil and gas companies. So private equity managers have that's been an opportunity for them to make money. As far as laws, now when I can't answer the laws, but when interest rates were super low 2 years ago, like 50 basis point 10-year treasury, we were totally fine with our private equity general partners borrowing money, because they could get a lot of debt at really cheap rates, and we knew they could pay it off. Now that rates have gone up, we want them to temper that a little bit. So it just depends on the level of interest rates and the environment. There's broader answers than that, but does that kind of suffice for now?
yeah, so where do you want your leverage to be usually? Or when, if it starts going too high, what doesn't scare you?
I think there's no answer for where exactly do I want it, but what direction do I want it going based on the current environment? If we're headed into a recession, I want people to bring leverage down. If we're at the bottom and we're coming up and rates are really low because the Fed has dropped rates to stimulate the economy, and they've got a really good business model, not a pretty good, but a really good business model where they're going to be able to pay off the debt, then I'm comfortable with them taking on more leverage. So as is typical in economics, it depends. It's a terrible answer, right?
Wouldn't it make sense to have like another variable like your credit rating, because high leverage for a highly rated company is not as concerning as high leverage for a, like high yield bond.
Yeah,
issue.
yeah. Any of you guys heard of Howard Marks? He's an author. He runs, forget the name, Oak Tree. He writes some good books on that, and he has a little graph of if something is very volatile, you want a little bit of leverage, but if something is really smooth, steady Eddie, you can lever it up because it's safer. So when I say, again, for the broader group, when I say lever it up, you can go into debt more to finance your business, your plan. Moving on from leverage to concentration. How concentrated is your portfolio? We look at everything across our different asset classes. You're not going to remember my colors, but public equity is green. This aqua color is private equity. This aggregates our exposure across our whole portfolio. So IT has really done well since COVID. Okay, think about Zoom and Microsoft Teams. They're making a lot of money. Netflix, people that are just doing things through a screen. So this is now the biggest part of our portfolio. before COVID, I think it was number 3. Financials, real estate, there's a story behind each of these sectors about how they do in different business environments, but we want to know that. We also want to know our currency exposure. Obviously, it's mostly dollar, but we got international. As of the time of this one, Apple was our biggest, Microsoft, Google. We'd have, anybody heard of this? Kaishu? No international students? It's a tech thing in I want to say China. I'm pretty sure it's China. So we'll look at our concentration there. And then our liquidity. You don't have to memorize all this, but basically about 60% of our portfolio could be liquidated in a day if you trust these metrics. Now, if someone says, hey, Utah Retirement Systems is trying to unload, whatever, 12 billion of stocks in one day, we're probably going to affect liquidity just a little bit. But so we would stretch that out, but I can't imagine a scenario where we want to do that. And then because we have liquidity here, we also can take on illiquidity. These are stuff that would take more than a year to sell. Real assets, private equity, hedge funds. We monitor that.
Your selling comes from opportunity versus just needing to liquidate because you're paying out.
We have, since I've worked there, we have not needed to liquidate to pay out benefits, which is a fortuitous position to be in. Other pension funds, we pay out 1.5% of our net asset value every year in benefits. That's net of the actuarial contributions coming in from the employers. Others will be 3%, 3.5%, especially if they're a pension fund that's not well funded. They're deciding every month what to sell. I've talked to risk managers of those groups in my little club, and it wouldn't be a job security for the risk manager as long as the pension's a going concern. I won't touch on that. Is anybody taking a class on private equity? You know how the cash flows work? Okay, I'll touch on this. If I invest with a private equity manager, I don't give them the money right now. I say, I will commit $100 million to you. And they say, that's great. We'll let you know when we want the money. What they do is they go out and they buy companies, and they say, once they have a good opportunity, 6 months from now, 3 months from now, 12 months from now, they say, hey, we now need, you committed 100 million. We need 20 million of that right now. And you're like, oh, okay. Well, I'm glad I understand how this market works because I have $20 million sitting here that I can give you. But if someone didn't understand how the market works, they'd be like, oh, shoot, now I got to go sell some of this or that or whatever to give these guys 20 million. This is not just something these are contracts set in place. You have to contractually give them the 20 million. You want to understand how the cash flows go. So when they say you have a $10 million buyout fund, over time, this is how they're going to call the money from you. You know, some of these are 8 years out, 7 years out. You want to understand these, the averages, how things work out. And then over time, they're going to give you the money back. Notice that all the area in here is bigger than all the area under here. That means they've made money for you. But you committed at time 0, and you made your last payment to them maybe the 8th or 9th year. They're not giving you your last payment until 20 years from the time you committed. Can you see why you or your grandma don't usually invest in private equity? Your time horizon doesn't usually work that way. But pensions, endowments, foundations can do that. Private wealth managers, you know, if you have $200 million and you go down to Wells Fargo, they'll get you set up with an investment plan that may include private equity. Okay. The irony here is that, I don't know if it's irony, you could pontificate on this. The United States by far, and I welcome you to challenge me after this, has the most mature private equity program in the world. Private equity means innovation. That is where things are created and developed and made more streamlined. And so because the United States, who funds private equity? It's usually pensions, foundations, endowments. So because the United States has a history of state pension funds, corporate pension plans, foundations, endowments, that is where this innovation is taking place. So just kind of a virtuous feedback loop.
Can we shift gears a little bit?
Yeah.
Day in the life, like what's your normal day look like?
I really wanted to touch, I'm just kidding. Day in the life, I'm wondering if I have a slide that illustrates
So-
this.
There's two things
Yeah.
I want to make sure we hit. What's your average day look like? Obviously, you're doing lots of technical things, you're looking at numbers, you're quantifying. How much in front of a computer doing that? How much talking to people? How much presenting? How much travel? Just give people a feel
Yeah.
for what type
Yeah.
of you're doing there. And then the other thing I would like to touch on is kind of career path, like you've gone the actuary route. What should students be thinking about if they want to think about these big questions in terms of risk and manage the risk down the road?
Yeah, okay. Day in the life, like I told you, I want to be able to provide answers to the chief investment officer, to the board. So I will spend an hour just understanding the economic landscape out there. I'll read articles from different research groups. Bank credit analyst is a good one. Bridgewater sends us some stuff that can be pretty handy. I want to know where the economy is going, so I can say, hey, if we go there, this is how it would affect our portfolio. I will spend, this would be an average day. I'll spend 2 hours on portfolio overall analysis. Sometimes that's doing the metrics that you see there. Ideally, I'm doing scenario analysis where I say, here's how everything comes together to see possible outcomes for our portfolio. I'm mostly behind a computer, but I'll have meetings. I'm on the senior leadership team, so involved in any big investment decisions. I will be collaborating with all of the different asset classes that I discussed earlier, talking to them about how it fits into the overall portfolio. Sometimes I'll run metrics for them. They'll say, hey, can I see how this fits into the overall portfolio? And then another hour and a half on any new specific deals that they're considering taking to what they call the investment committee. I travel about 4 times a year. I could do more if I wanted, but 4 is just right for me. I'll go to conferences. If I'm in New York, I'll stop by 12 different investment managers to talk to them about their portfolio, see how it fits into my objectives, what I want to do as the risk manager, balancing the risk reward. Backing up to the scenarios for the overall portfolio, I'm doing risk reward things to say, hey, how does this asset allocation impact our objectives? I'm chatting with people, intensely, an hour and a half a day.
Mostly those are internal or external?
Mostly internal.
Internal, and
Yeah.
those folks have been chatting with the kind of feet on the ground.
Yeah. I have access to the external people though, if I want. I told the group earlier that as far as research, the world's my oyster, because I can call up anybody and say, I want to know BlackRock, where you think interest rates are going. I want to know Bridgewater, where you think interest rates are going. Some people will say, risk people, this is a great job for introverts because you don't have to talk to people. I like the balance. I can put my head down and go to work, but I also like chatting with people and bouncing ideas off of them. Yeah,
Basically,
yeah.
remote at all?
Yeah, well,
Did it affect your job much when it went remote with COVID?
it didn't affect it at all. And that's because we had a good thing going, me and my analyst, and how I interact with the rest of the team. Maybe I lost 2% of something, but I gained it back by not having the commute. Yeah, 8 to 5 type job. Nice work-life balance. So.
Questions about that? Any questions about his kind of an average day and risk analyst? Yeah.
Yeah.
Do you have a team that you work with, or is it like, are other people doing this with you, or is it just you kind of doing all that?
So it's me and an analyst, and we're looking to expand the team.
So is it typically about 1 or 2
For an asset owner, I'm using this term for pensions, foundations, endowments, they'll usually, if they're smaller, they'll just have one risk person. If they're about the size of Utah retirement systems, it'll be 2 or 3. If you get like huge, like some of the Texas funds or like California pension for public, for retired CalPERS or CalSTRS, one for public employees, one for teachers, they'll have a risk team of 20 people. They're managing, I forget the latest number, 350 billion, 400 billion.
This is kind of high end in terms of risk management. Some funds, some banks, I mean, there's different levels of risk management, risk analysis, but kind of the same idea. You're trying to trade off between risk and reward, and within their specific setting for the company, I mean, insurance companies have lots of folks that are looking at different numbers in terms of their risk exposure, kind of the stuff you did previously.
Yeah.
So lots of
And thanks for bringing that up. I'm focused on the way I've done it. If you're a risk manager for an investment fund that's out managing other people's money, you have a daily risk job, and you may buy protection, insurance options to make sure that bad things don't happen. And there's a premium you have to pay for that, but you don't want to go back to your investment managers to say, hey, we lost your money because I didn't buy this option that could have protected you. That's you can teach a whole class on that. If you get into options, it can be intimidating at first, but if you get it into your blood, it becomes more natural, and people are happy to pay you for your knowledge of options and the market.
I guess, could you just expand on different career opportunities for risk management people other than just like pension funds?
Yeah.
What other like paths are there?
Well, there's investment risk management, which is what I'm talking about. So you could do it for a pension. You could do just what I described for a money manager, where you're the risk person doing that. And that's much more rigorous and day-to-day to make sure that things, I mean, it depends on what you're investing in. But to make sure that you're protected and you're within bounds. You don't want to go tell the people who, like I just said, whose money you invested that, yeah, sorry, I lost 15%. You want to have protection for that. It depends on your strategy and your dialogue with them. You don't want to lose money outside of normal expectations. Let me put it that way. As far as how you get there, I struggle with this as far as the best path. I would say an econ degree, if someone wanted to do risk management, get exposure to the financial markets, either through work or the CFA or something like that. Good quantitative background, stats minor is not going to hurt. And then there's some designations out there. There's the FRM, Financial Risk Manager, through GARP. Sounds like a weird name. Global Association of Risk Professionals. Does that kind of answer the question?
Yeah.
Okay. What else, Ryan?
Yeah, so in terms of when you say econ, like our econ and finance are really together.
That's great.
Overlap.
Yeah. Because
it's more the quantitative aspect that you're thinking of.
Yeah.
Though, is that understanding the numbers, understanding how to quantify things, understanding how to measure and run analysis on data.
Yeah,
it's going to be important.
Yeah, I appreciate you bringing that up. There's a econ department in the state. It's not here at Utah State, that you can come out of there without much of quantitative background at all. And so yeah, you want the quantitative aspect of econ would help.
What do you wish you would have known? Yeah. Like given your career path, what do you wish you would have known beforehand, or in terms of preparation? Anything you would have done differently?
You know, as far as my path, it was okay. Just to be, and this applies to anything, be intellectually curious. Someone throws something at you and you don't understand, throw yourself at it, dig in, ask the questions, go deep. Intellectual curiosity is you can't pay enough for that for an employee. Someone that'll go figure things out.
Don't wait. I hear back from employers all the time, and they say that about Utah State folks, that Aggies will just get their hands dirty. Sometimes you just got to get into it. Go figure it out. And you might not know it all from the beginning, but if you're willing to work at it, you'll figure it out pretty quick.
Yeah, it's knowable because someone knew it. So why not you? Why not throw yourself at it? be that subject matter expert.
Other questions?
I have one that's like not super on topic. So I've seen that social security is just like not really gonna exist.
It's a Ponzi scheme. Yeah.
Yeah.
Sorry, go ahead.
how is
You
that-
probably know more about it.
What do you predict will be our reality with social security?
You know, I don't know. I'm going to back up and I'm going to say what it boils down to is a governance issue. Governance meaning who's making the decisions. Now, if you'll bear with me for a little bit, Utah retirement systems, we have a good governance system because we don't have elected officials on our board that are trying to make a name for themselves or rock the boat. These are people appointed by the governor that have an investment background, and their only interest is to help the fund succeed. Or if you go to California, other places, you get elected officials, they see it as a stepping stone. They're just trying to rock the boat, and it's just bizarre. The reason why I bring that up is because we have a good governance structure where we can make decisions for the benefit of teachers, firefighters, state workers. Problem with Social Security, not being an expert, is that how is it governed? It's governed by politicians that are trying to get reelected in 2 years or 4 years or whatever. And so you've all heard it, you kick the can down the road and no one's making a decision. And so what's that going to mean? Is it supposed to run out in 2034, 20, something like that? Someone's going to make a decision at some point. I think they might be waiting for more baby boomers to die because that's a big block that votes and you don't want to take money from old people, but money has to come from somewhere. And frankly, the baby boomers have had a pretty good ride. I'm not trying to vilify, I'm not trying to do the hey boomer thing, which I think is ridiculous, frankly. But they've had a pretty good ride and someone has to pay for it. I think they still have it. The American Academy of Actuaries, if you just Google Social Security, how to fix it, actuary, they have a little exercise in there where you say, what decisions would you make? Would you decrease benefits? Would you increase contributions? Would you increase the retirement age? My guess would be they'll increase the retirement age and increase contributions. That's fun to talk about. Thanks everybody else for
Okay.
bearing with me.
Running out of time. If you have more questions, you're interested in more, I'm sure guys happy to have you reach out.
Yeah,
So I'll just post your information on the class site. So or you just your LinkedIn page, they can reach out to you or your email,
yeah,
they can reach out. That's okay?
yeah.
Okay. Or stick around for a second. You can ask another question if you got one that you just can't wait. But hey, let's give a round of applause and got a little swag bag for him here.
It only gets better from here. The next guest lectures will be much more interesting. Perfect. That's still on.